What is UBT in a self-directed IRA? Have you ever wondered how certain income can affect your self-directed individual retirement account? Understanding unrelated business taxable income, or UBTI, is essential for anyone using these accounts. UBTI arises when your self-directed individual retirement account generates income from business activities that do not align with its primary purpose of providing retirement income. Typically, individual retirement accounts grow tax-deferred or tax-free. However, UBTI represents income from active business operations or certain leveraged investments, which can trigger taxes inside the account before you take any distributions. This is important for self-employed individuals and those looking to diversify their retirement portfolios. Self-directed individual retirement accounts allow you to invest in alternative assets beyond traditional stocks and bonds. These can include real estate, private businesses, or partnerships. When these investments generate income from an active trade or business, such as running a restaurant or a gas station, that income is deemed unrelated to the retirement purpose of the account. As a result, it falls under UBTI rules and becomes taxable. There are two main scenarios where UBTI typically arises. The first is through active business income. If your individual retirement account invests in an unincorporated business, like a limited liability company that operates a retail store, the profits from that business will be classified as UBTI. Since your individual retirement account is a tax-exempt entity, it usually does not pay taxes on investment income. However, active business income is an exception and is taxed accordingly. The second scenario involves debt-financed property income. If your individual retirement account uses leverage, such as a non-recourse loan, to finance part of an investment, commonly in real estate, the income attributable to the debt-financed amount is treated as unrelated debt-financed income, a subset of UBT. For example, if your individual retirement account buys a rental property partly with borrowed funds, the income related to that borrowed portion becomes taxable under UBTI rules. For retirement planning, if your self-directed individual retirement account earns $1,000 or more of UBT in a year, it must file a tax return and pay unrelated business income tax on that income. This tax liability can reduce the overall growth inside your individual retirement account and complicate the tax benefits typically associated with retirement accounts. Being aware of UBT is vital for self-employed individuals or investors using self-directed individual retirement accounts. It can significantly impact the tax efficiency of your alternative investments. While these accounts offer greater flexibility and control over your retirement assets, certain active business income or leveraged investments can trigger taxes inside the account. This could potentially reduce the growth of your retirement savings. Understanding UBT helps you manage tax exposure and make informed decisions about your retirement investments.